First off, just on the quarter, we had record earnings per share for the quarter and for the year. And we've got a number of powerful engines. One is this deal environment hitting escape velocity. We did 4 IPOs in the second half of the year, led by Medline, which is a terrific business in Chicago, and the market reception was quite positive. It feels to us like that 2013-14 period where after the hibernation following the GFC, we began to take a number of companies public, notably Hilton Hotels. And it looks like it should continue. As long as markets stay where they are, I think we will see a lot of activity. That's obviously good for us and our investors. I'd also point out for us that the decision we made to lean into AI infrastructure, becoming the biggest investor in data centers, becoming the biggest provider of private capital to utilities, the lead investor today in electrical equipment and related services, that's really delivered great results, and there's a lot of momentum there as well. And then I'd just say finally that we continue to see this secular shift towards alternatives. Insurance companies, individual investors, institutions. We had 71 billion of inflows in the quarter, 239 billion in the year. So a lot of good things are happening, but certainly the deal backdrop is quite favorable.
Whenever things are so good, people love to pick for holes in it and reasons they might not be good. John, there was a Bloomberg survey of private capital investors basically saying what could blow things off course. For them, it was macroeconomic or rate instability. For you, what is your concern that could blow things off course, and what is set up to be a strong year?
Well, you always can have things geopolitically. That's a risk that always exists. Certainly long rates, if you saw that back up, that could slow down the deal environment. But I'd say overall, the picture looks pretty good. We've got an economy with a fair amount of strength. Our private equity companies in the quarter had 9% revenue growth. That's obviously positive. We continue to see cost of capital coming down. Spreads are at very low levels. That's helpful for the deal environment as well. And then this AI world, this huge investment that's happening that we're helping to facilitate, and then the huge productivity boom that's going to come, I believe, after that is another positive. So there are always risks out there. You've got to be thoughtful on how you deploy capital. But the overall environment to us feels pretty good. I think this should be a strong year.
How do you navigate that AI spend specifically? Obviously, a huge boon to Blackstone. But on the other side, you have, for example, in public markets, Microsoft has earnings yesterday, and everybody freaks out that they're overextending themselves on CapEx. How do you find that balance of investing and capturing this new economy versus the fear of overextending yourself and bubble fears that emerge?
Well, I'd say how you invest really matters. So a lot of what we've done here is, as I said, this infrastructure, and it's based on long-term contracts with credit-worthy counterparties, and that makes a huge difference. So if you're building a multi-billion-dollar data center in the US or around the world, and you have a 15-plus year contract with a company with a $3 trillion market cap, that feels pretty good. Similar dynamic if you're doing something around energy, be it an LNG or a new power plant, you have a long-term contract. So I think there are ways to do this that are more downside protected. At the same time, we're trying to capture the upside selectively, around some of the big LLMs, around some of the application software, but we're mindful of how much investing we're doing. We're also mindful of the risk, but there's also a fair amount of upside. I do think what's interesting is everyone's focused on these bubble risks. I think the biggest risk is actually the disruption risk. What happens when industries change overnight, like what we saw to the yellow pages back in the 90s when the internet came along, or what happened to Uber when Uber and Lyft came to the taxi business 10 years ago. In the last 2 weeks, we saw JP Morgan say they're going to stop using proxy advisors and use AI instead. We heard Lemonade say that if you use your AI-powered self-driving Tesla, during those miles, we're going to cut rates by 50%. What does that mean for insurance companies? What does that mean for collision repair companies? And so we're spending tons of time thinking about rules-based businesses, accounting, legal. How
Well,
are
John,
these
if I can
businesses
just
gonna
jump
be
in, what
changed?
about on the portfolio company side? Are there companies or industries that you're rethinking or wouldn't touch or wouldn't put new money into because of the fear of AI disruption?
There's definitely more risk in certain industries. There's no question that you have to think about some of the lower value IT services businesses, some of the businesses that are intermediaries where you may have these agentic agents, these agentic commerce happening, which could change the way we do things. I do think looking at each business is really relevant. And when you think about things like software, for instance, is it a vertical software that is sort of the system of record for a business that is very hard to rip out? Or is it some low-level horizontal software where it's easy to change and therefore the AI could lead to a big erosion in your business? And so every deal that we're doing today, in the first 2 pages of the memo, we're saying, what is the AI risk? Now, if that is, a quick service restaurant chain or an apartment company, there's lower risk. But there are plenty of businesses that are facing real challenges, and we want to focus on that. We want to look at our existing portfolio in the same way. And I would also say that it's not static, because if you buy a business that has real incumbency and they can transform to become more efficient using AI, they can end up being a winner. So I think awareness around disruption, awareness of change is so important. I do think it's one of the competitive advantages in the US. I think the adoption here is going to happen quicker than the rest of the world.
And you've mentioned this, the productivity edition of it. Goldman Sachs's David Solomon was talking to Bloomberg and said that the impact on Goldman means that talent growth is going to be slower than it had been in the past because of the productivity ad. Is the same going to be true for Blackstone? Sure, talent growth, but will it be slower because of the technology you're adopting?
We're a fast-growing company. It's hard to say. I do think in certain areas you could see greater efficiency. This AI gives our folks in some ways sort of superhuman capabilities. It's making our software engineers twice as efficient. It's making our cyber monitoring people 30% better. We're starting to use it in some of the legal areas like marketing compliance. But at the same time, it's allowing us to also assemble data and do things we couldn't in terms of content creation, looking at all the streams that are coming from 270 companies, 13,000 pieces of real estate. So, it may have an impact. We're a firm that doesn't have a ton of people relative to some of those other bigger companies, but I do think there will be efficiencies out there, and that is going to lead to, I think, generally higher margins in a lot of industries over time.
I think we're all going to be looking forward to your first AI-produced holiday video, a highlight of everyone's end of year. John, just on a more serious note, I can't let you go without asking about the disruption coming from policy in Washington, D.C., be it a government shutdown that delays deals or IPOs, or pronouncements from the president on social media about things like investing in housing or new tariffs. The policy we're getting, how much friction has it introduced into your investment process?
Well, often there are issues that come up. A number of them, get resolved over time. And we've generally counseled patience with our investors. We talked about this after Liberation Day, let the tariff diplomacy play out. You can get worked up. We saw this around the Greenland situation, which ultimately came to a resolution. So I think the key is to take a longer term approach, see where these things land. In some cases, it can impact businesses, and therefore you have to adjust in a certain way. But I think that patience is important. And at the same time, obviously, there are some positive things that have come out around the regulatory environment for M&A, which has helped our business, allowing more energy to get built and distributed, which has helped. So it's just part of the environment. We take this long-term approach. I think what's happening in technology, the investments there, the productivity, that will ultimately be determinative of success. And as investors, you want to focus on that long-term big picture.
But when you are getting, announcements on housing, for example, I know had a short-term impact on Blackstone shares. Do you think that this is a market that needs more clarity coming from the White House? Is there something missing when it comes to both delivering policy and just the knowledge of whether it comes to pass or not?
Well, each one of these things is different. On the single family front, I have a lot of sympathy for policymakers because we do have a housing affordability crisis in the U.S. but it's really driven, of course, by a lack of supply. We're building 20% less homes than we were in 1959. Now our population has doubled, and institutional owners own a very small piece of the overall market, half of 1%, buying's down by 90%. You know, this is not always done today, policy-wise, in a traditional way. But as investors, we just have to respond to what's given to us. And so when these changes come out, we will respond accordingly. Often we'll be patient. We'll see how these things evolve. I think, as I said, staying focused on the big picture is the key, and the underlying strength of the U.S. economy, the underlying productivity gains, the fact that cost of capital is coming down, rates coming down, inflation coming down, these to me continue to be the key elements of investing today.